waiting for Todd to join me. We seem to be having some difficulty with the sound here at Minyanville. Let me talk a little bit about how this book actually came about, because it really is a function of the Minyanville community. Back in 2009, Kevin DePue did an interview with Bob Prechter. Many of you may know Bob from Elliott Wave. I was not familiar with Elliott Wave at the time, nor at all about the things that Bob was doing in the world of socioeconomics. And as somebody who had followed the banking industry through the banking crisis, I can tell you I've never been so right and so wrong at the same time. A macro view of what was happening to the financial services industry that was really experienced through a series of very strong roller coaster movements. Folks who understand wave theory, who look at the way markets move much more than I ever did, understand that markets don't move in straight directions. What Bob's work in socioeconomics did was to really help me begin to see how important sentiment and changes in mood, and particularly how confidence applies to all of this, really affects the markets. And that led me on an excursion to look at a number of different ways that markets and mood tie together. When I was a kid, my father used to say, "Know where you are in time and space," and little did I realize at the time that how important those words were. And the more I looked at social mood and how mood affects our decision making, what I realized is that we, in effect, wear variable lens goggles, where as our mood improves, as confidence rises, it's as if the peripheral vision that we have expands. Our time frames expand, our relationship frameworks expand, and we also become adventuresome geographically. So there's these three dimensions that I looked at very closely, and you could see over long periods of time how they tie together. How, in the 1800s there was a bull market while people were talking about "Go West, young man," and that space exploration ties to a great bull market in the 60s. And so that led me to really look very hard at things that you could see in everyday life to see what does it mean if we have a bull market or bear market. How do you read the markets? So Todd just handed me a list of questions, and I'm going to try and answer some of the questions that Minion folks contributed, and see if I can apply a socioeconomic framework to it that might make some sense. So one of the questions that I got was, are there safe assets available to invest in if you're a high net worth individual? Discuss if there are safe assets in the marketplace. One of the things that I think is extraordinary about the world that we're experiencing today is that you've had these successions of bubbles. And one of the things that we, I think, are in the midst of right now is a bubble in things that are safe. And you say, how can that happen? Well, there seems to be an awful lot of agreement that these are markets that you need to avoid, the equity markets, and so people are trying to hide out in the same thing. And, when everybody wants to do the same thing in the markets, funny how that all of a sudden becomes a bubble. And I think that's one of the things that's been so interesting looking at social mood in this regard, is that markets and investor behaviors are clearly herded. And what I see at tops and bottoms are these real social vortexes where everybody wants to either be in something or be out of something. And right now, the thing everybody wants to be in are safe assets. And what's going to be interesting to follow from here is what happens to safe assets when they are no longer safe. And I worry a great deal about a market where these places that people have hidden out, particularly in the bond markets, go the other direction. And it's very hard to, you look at bond yields that got as low as, the 10-year, less than 1.5%. And, the asymmetric risk is very clear. And so I do think that we're in an environment where safe assets are too crowded to trade. Too many people are believing that that's the only place they should be. And at the end of the day, that's one of the things that determines where you have bubbles and market turns. Now, the question would be then, where do you go instead? And I think that as I look at the place nobody wants to be, and that is cash and the money markets, and I would expect that I'll get laughter and some angry emails, but those angry emails are great indicators of the fact that it's not popular, and those tend to be the places that you want to be as an investor. The more you're derided. I talk about market tops and bottoms from a social mood perspective as being very reminiscent of middle school, where there's the sense that you want to all be doing the same thing, and if you're not doing what everybody else is doing, you are very much an outcast. And so when I talk to people and you get a sense as to what everybody's in, you throw things out that nobody wants to be in, suddenly you get a sense as to where the market's mood really is. And no one today believes that cash is a place you want to be. On the Fed stance, will they ever be allowed to exit the Treasury market? Does QE work? I am fascinated by the questions that relate to the Fed and how people perceive the Federal Reserve to be impacting the markets. One of the most telling studies in terms of the Federal Reserve's impact on the markets is actually one they did themselves. And they recently, some Fed economists here in New York, looked at how the markets move relative to Fed actions. And what you found was that most of the action actually preceded the Fed's action. And that's important to me because it's a reflection of confidence. And, people's belief that the Federal Reserve would or couldn't do something. And I finally see Todd on the screen, so we're actually able to communicate now.
Can you hear me?
I can hear you.
Wow. Thank you. In my next life, I actually want to have a media company that mediates.
It happens to Bill Gates too.
Well, I know. This was no fault other than the path of maximum frustration. It was no fault of the Minyanville team. We actually, my internet line specifically went down, so I apologize for that. But I was enjoying listening to you nonetheless, Peter.
I still love it.
Yeah, so we'll extend it a little bit, balance be damned, because I know a lot of people have tuned in for this, and I can see a lot of people have tuned in for this. As I was trying to say earlier, I really was looking forward to talking with Peter. I've known Peter for a few years. Old school Minions would know him as Minion Peter back during the crisis in 2007, 2008. He used to write in, and he caught my eye for his acumen and insights and really his grasp on what was going on in the finance-based economy. And lo and behold, it turned out that he has a very credible and impressive background in the financial services arena. He's the president of Financial Insights, which is a must-read for professionals. And he has a great book, Moods and Markets. I don't have a book handy, but I have a hat handy. I read this thing in one sitting. It's terrific. So with that as a backdrop, and with my apologies again for the technical snafu, and hearing what you're saying, Peter. So, okay, quicken the cadence a little bit. Do you think we see QE3 into year end? Do you think it has an impact? And what does it mean for the markets into year end, into the elections? And in the near-term period, in your crystal ball. Mine's in the shop. Does your crystal ball say?
I think that we eventually see QE. My concern continues to be the level of confidence that people have in the Fed and central banks in general seems to be deteriorating. In 2009, you saw the Wall Street Journal, or I guess the beginning of 2010, they put a picture of Ben Bernanke on the cover of the paper in a Superman suit, holding up the world. 2 weeks ago, the editorial team of the Wall Street Journal described central bankers as the music men, a group of folks like Harold Hill who are nothing more than con men. That's really very interesting deterioration in confidence. And to me, we believe in the Fed, and the Fed is effective only so long as we believe in the Fed.
But that becomes a timing question, right? So in 2007, we were talking back then about how the two hedge funds at Bear Stearns, what that meant. And that, it took a good year to really percolate to the mindset of the masses. So the question now is, are we in this state of suspended reality where everyone's kind of saying, well, we all know about Europe. It doesn't really matter now because the reaction to news is more important. The markets are just grinding higher. Is it behind us? Because I'm wondering if I'm wrong because I've been very cautious and I've been wrong for the drift higher. But is Europe out of the woods? Is it one conversation now in terms of the fiscal house?
I think of this as rolling blackouts. So we had a blackout in 2008 on financial services. We're experiencing a blackout now on Europe. Europe, every indicator that I see, Todd, is of a group becoming more isolated, becoming less willing to compromise. Those are all signs from a social mood perspective that only accompany bear markets. So I don't see.
Meanwhile, Germany's up 1,000 points, over the last since July. I'm cuffing it, but I remember we were talking about DAX 5,800. It got to like 5,900. Now it's at 6,900. I agree, in principle, and that. My question is from a time and price standpoint. I've been waiting for the sovereign sequel. We talked about the lifeguards, the sovereign lifeguards saving corporate America. Who's going to save the lifeguards? But I'm just playing devil's advocate. By the time the solution is self-evident, or the markets are going to be pricing that in as a forward-looking discounting mechanism.
No, what I see today are markets that are, self-assured that central bankers can solve this, that policymakers in Europe will do the right thing. But it's very similar, though, Todd, to 2008, where you saw the weakest organizations fail first. So look at the stock market indices from Greece, look at Spain, look at Italy. It's the same cascading effect that we saw in 2008 where, the Bear Stearns, the new centuries of the world went first, followed by the very large, perceived very stable banks, very close to the end of the crisis. You really didn't see them beginning to collapse under the weight of sentiment until the fall of 2008.
But so I'm getting. You didn't lose me. Can you hear me?
I can hear you.
Okay. I'm a little bit paranoid for good reason here. But I'm starting to get the same sort of sense. There was a period. I remember back in 2007 when we talked about how, and it was actually Dennis Sedaka, may rest in peace, who was talking about banks being technically insolvent, FASB 187, and off-market securities. If banks had to take them onto their balance sheet, they would be insolvent. And it felt very wrong at the time. And this was back when banks were making all-time highs in 2007. And then, it was denial migration panic on the way down. And then, of course, in 2009, we're up buck justice about 100%. Is it that linear? Is it just going to be, has technology just kind of just compressed the business cycle and the mood swings into these, tighter and tighter shelf lives, in your opinion? Is that what we're seeing?
I think you're seeing the impact of interconnectivity. I think that technology does play a part. In doing some research, I came across some comments about the panicked 1857. And what made that panic so different from the ones in the past? Morse code. The message could move so much faster than it did in prior panics. So yes, this is an environment where communication and speed really, alter the landscape. And that to me is all about, how we heard and the fact that mood moves quickly.
Well, I'm sorry, go ahead.
Go ahead.
No, so if we kind of juxtapose that, and I agree with that, with the mechanism and the leverage in the system, the high frequency trading and the DNA of the market, and and how you're having more systems basing decisions on algorithms rather than human beings actually taking a step back and saying, wait a second, we're getting a little bit carried away. Have we, where are we in this process? Like, if it is done denial migration panic, what is it going to take for people to trust the markets again? Is it as simple as time and price, or is it going to take just because you look at that, I was always, and I believe still, the millennials are going to, kind of be the generation that saves, this nation of ours. But now they're getting burned on Facebook. They're seeing their parents losing their homes. They're seeing their parents without a paycheck, and you have a 40% odd unemployment for 18 to 22-year-olds in this country. What is it going to take for people to trust the market again?
Well, for the millennials, I mean, one of the things I love is all these articles about how they've become Generation R, Generation Renters. They've translated uncertainty into all of their consuming behaviors. So they've become me here now in a world where, it's all been made available to them, from home renting to fashion renting and, zip cars and all of these things that, clearly address an uncertain clientele. You ask what does it take for the retail consumer to come back into the market? A couple of things. One, I think we have to get to a point where nobody wants to be in the market collectively, and we haven't seen that since March of 2009. So, you only come back into the market after everybody's concluded nobody should be in the market. But appreciate too, Todd, retail is a late entrant into markets, period. You and I think of it as a normal, but go back 20 years, go back 30 years. In the context of a confidence cycle that runs from the depths of 1932 to 2000 or 2007, retail participation is not a long-term phenomenon. It's an end-of-the-cycle phenomenon. The naive, the novice come in at the end.
So there's a lot of people on this call, and it's a very, the hard question here is, what do you do? What's safe? Where do you put your money? Cash is obviously, the obvious choice, but you have currency risk, which people have actually not talked about a lot recently, but I think is still part of the conversation, whether it's 5%, 10%. Whatever the case may be, gold's just kind of sitting around here. It has been for the most part. But what's safe? In your opinion, if you have money that you want to eke out a little bit of appreciation but don't want to lose, what do you look to?
Well, I think it's not about eking out appreciation at this point. I think it's avoiding deflation that is hitting, product after product. You look at the showrooming that's occurring in Best Buy. To me, that's a clear deflationary behavior, because you now have learned it pays to wait. And the behaviors that I see over and over are of people who are postponing purchases. And that, to me, is an environment of deflation.
But in a deflationary environment, the dollar presumably appreciates, right? Asset classes come down, the dollar rallies. Is that, are we at the point now? Because I know when I talk to people, when I talk about deflation, well, you were right once, you got it right once, but you're holding on to a lost argument. Now, is that the type of the sentiment and behavior that you hear closer to a cycle top, or is that my senses, or is this gonna, are we gonna continue to fight it, a la 2007 or 2006 into 2007? The timing is important. I don't know the answer. But I do know that you have a motivated Federal Reserve, Bank of England, ECB, Bank of China, Bank of Japan. I remember back in 2009. I was actually I saw Bill Fleckenstein out in Hawaii in 2009, and he, if you remember, in March of 2009, he had closed his short fund and rolled everything into gold, which was a hell of a call.
Right.
On his part. And, I said, well, what about the next manifestation? There's going to be credibility in government. There's going to be social mood. Don't you see it? And, his response, and a very smart guy, he said, of course I see it. How do you not see it? But, that's one of those fights that you don't want to pick, because what if you win? And you're fighting an institution, you're fighting the world effectively. Is it wrong to fight the world? In the 100% higher, you have to ask the question: Is it wrong to fight the world?
Well, and I think that's the fact that you're asking that question today, Todd, speaks to the confidence that still exists in the system at the same time that you've got now more than 10 countries around the world who are issuing bonds at negative interest rates. And
you think we have to see negative real interest rates before this ends?
I think you see negative real interest rates before this ends.
Do you think we see negative interest rates, period? Pardon me.
Oh, yeah. Absolutely.
So you think that
not terribly far out the curve, because I think that my view on interest rates is that there's an enormous pivot that's going to take place where people you have people worried about long-term credit risk at the same time they're exiting other instruments to get into cash. So you end up with this very steep yield curve.
So do you think that we get to a point where, let's say I bank with Wells Fargo, I don't, but if I did, that if I went to Wells Fargo and said, I need you to watch my $10, they're going to turn around and they're going to charge me X% to watch my money and safeguard it. Do you think we get there?
They're doing it every day in Denmark, in Switzerland.
Do you think we see it here in the United States?
Absolutely.
Okay.
And that has huge implications for things like money market funds.
Well,
where today the industry is subsidizing rates.
Well, that was one of my next questions. There's a gentleman who I know quite well, Chris, who is writing in and saying, what are the unintended consequences of all this easing over time from a mood standpoint? Is it, and from an actualization standpoint, inflation, deflation. I, as you know, have written about the unintended consequences being the tricky trifecta of societal acrimony, social mood, geopolitical conflict. I think we've seen societal acrimony. I feel it out there.
Mm-hmm.
Social mood, whether it's Occupy Wall Street or the riots in Europe, I think we can check the box there. And now you got obviously increased chatter about something in the Middle East or, God forbid. How do you see the unintended consequences mapping out differently? What is the positive takeaway? What can we look forward to?
Well, I think that the real positive is what you're seeing already in the community front. I look at what's happening in food as a leading indicator of social mood. What we eat, how we eat, seems to move more quickly than anything else. And what I see there are things like CSAs and the locavore movement. There is a real rebirth of community around what we eat. And I think you're going to start to see that expand to other areas.
I've had a community around what I eat for the last 20 years. It's, my favorite part of the day. But you talk about corn in particular. We talked about this before you came on. How does corn measure social mood?
Well, I think that it's important to realize that commodity tops act like equity market bottoms. So they are sharp. There is a sense of shortage, panic, and watching all of the stories on screen TV of late with story after story of farmers plowing in crops. You've got Commerzbank announcing last week that it's going to take agricultural commodities out of its commodity index funds. Sort of an interesting, act of sacrifice because they're worried about, the implications societally. CNBC today running an all-day special on the drought. I love CNBC specials. To me, they are one of the best indicators of major market peaks and bottoms. Remember Apple TV this spring? If you look the June low in the market, what does CNBC do the Sunday night before the low? They run a market in turmoil special. I feel that way right now with corn. All of the media hype, that social vortex is alive around the drought, and everybody's now expecting it to flow through to food prices next year.
Yeah, no, but listen. I think that the bifurcation and deflation and inflation is. We've been talking about it for a long time, and the
needs versus wants.
Right, inflation is things you need, and deflation is things you want. And how that skews in the indices and the BLS, we can leave for another time. I think that one of the more bullish things out there is that we're actually, we're 4 or 5 years closer to, we're 4 or 5 years through this negative wave, this negative cycle. What I haven't been able to reconcile, Peter, and maybe you can help shed some light on this, is I feel like the world continues to be under pressure. As we see it in unemployment, we see it in social mood, we see it in just people's moods and attitudes, whereas the markets are telling you we've already begun a recovery. Obviously, the reconciliation, you can say the markets are never wrong, but with 15 trillion plus in stimulus pushing up against 1.5% GDP, what's the tiebreaker here?
Well, I think you need to look at things denominated in real versus nominal terms. I think one of the biggest ahas to me in writing this book was charts that Stephanie Pomboy put out that showed the S&P in nominal terms and the S&P denominated in gold. And when you look at the S&P denominated in gold, so take your 14, whatever it is today, and divide it by 1600 and plot that back, what you see is an unbelievable correlation to social mood. And so, to me, what we've had is a devaluation of nominal dollars thanks to the rise in gold in the last 3 years to your Bill Fleckenstein trade. But the reality is that mood was lower in October than it was in March of 2009 and has not really improved much since then.
I think the squeeze is on, and I think that's probably a big reason why we're feeling it. I feel a sense of deja vu insofar that I feel like we've had this conversation before. I remember, my grandmother calling me, and I had told her early on in the last decade to be very careful because she was getting pitched hedge funds, and I said, Grandma, how much of this can you afford to lose? And she said, none of it. This is my retirement. I said, well, then don't bet it. By the time we got to 2007, she was kind of turning away from that discussion. She's like, I can't live on 1%, 2% a year. I'm counting on 5% to 7% returns a year. And she got, thankfully she did not get squeezed back into the market near the top in 2007, 2008 when things started turning down. I feel like we're kind of getting back to that conversation where you're hearing a lot of people talk about, well, what's your alternative for cash? There's a lot of cash on the sidelines. How do you reconcile that discussion, in terms of people feeling like they need to earn more so they're getting squeezed into riskier assets? What inning do you think that's in?
I think it's very close to the end. You look at the reach into high yield munis, take a look at the chart of, all the high yield junk bond ETFs. They to me suggest that people have been forced, in a low rate environment, to squeeze whatever yield they can possibly find out of whatever it is they can possibly, get it. And, those charts really are worrisome to me because it's a complete abdication of risk management out of necessity. People need to eat. People need to, put food on the table, and that's in an environment of zero interest rates, they had to find something else.
So how and kind of like as we start to kind of look toward the home stretch of this, how impactful do you think Facebook was in terms of social mood? Was it a symptom, or was it more of kind of the root cause of what we're seeing? Because I know, we were very, let's say, cautious on the deal, and then one of the few media outlets to say, don't believe the hype, to borrow a phrase. So Facebook, in the grand scheme of things, is it just more of the same? Is there, other than the fact that we have to go through this to get through this, what other, what are you seeing out there that what are you watching in terms of a turn, both ways?
Yeah, I think Facebook is, the perfect me here now company for a low mood me here now world. Twitter might be, a close second. The fact that they are bubbles that have peaked, to me, is a real strong indicator that we've squeezed out of the market, squeezed out whatever profits you can from me here now businesses. And they didn't like it the other day on CNBC when I talked about Apple being another example of that. Green Mountain Coffee. On the nasty front, the gun companies, pawn shops. I mean, all of these me here now companies, those stocks have turned hard, many of them.
Are there any sectors that you like on a relative basis? I know you don't do stocks. I'm not going to ask you for stock picks.
Yeah, I don't.
I hate when people do that to me, and I'm not going to do that. Do you think on a relative basis, where are there any areas that you're going to look to as we kind of go through this? Are there any laundry lists that you're pulling together that you're going to look to?
Yeah, the companies, the areas that I like from a relative standpoint are companies that will take advantage of growing deglobalization. So warehouse companies, for example, at ports, because global companies now need just-in-case inventory on domestic shores. Things that are related to domestic energy production, because globally you're going to see just this continued drive to national self-sustaining energy. I like things that are redundant. Infrastructure, so things in energy and technology redundancy. And I think ultimately you're going to start to see, from a nationalistic perspective, people really looking at the supply chain of critical goods and services. Could we make the car from bumper to bumper today in the United States with the borders closed? Could you manufacture aircraft in the United States with the borders closed? Those are questions that I think as nationalism mounts and the world deglobalizes, people are going to need to answer, and those represent opportunities to me.
I couldn't agree more. I'll tell you, on a personal basis, I had to buy my first car in 12 years, and I went with the Ford Flex, the ultimate in mommy wagons for the suburbs. I'm proud to own a Ford, and it's an interesting dynamic for sure. As we look to tie up, Peter, is there anything, any random thoughts that you have, any shout outs that you'd like to give? You got a full house here, so feel free to take advantage of it.
Well, I think I owe you and the folks at Minyanville a huge amount of
that's not what
thanks for helping out with the book, and certainly the folks in Gainesville, Georgia, Bob Prexter and the team in the Socioeconomics Institute were invaluable. But I think if I have a shout out to the group, it's really use the world around you. Culturally, if we're all sitting at home listening to Adele sing breakup songs, that flows into the markets. If we're watching, the Hunger Games or Dark Knight, I mean, these are the cultural world will tell you more about the markets than you ever think. What you're eating, how you're eating, those guideposts. If you're reading. The Greeks are eating in now. They used to go out. I mean, all of these things are fabulous indicators of sentiment.
Well, listen, I thank you, and again, I'd like to give a shout out to the Buzz and Banter team and for the Minyanville editorial team as a whole, because it's not easy these days to pull together quality content and be able to offer services, and these guys bust their ass every day to do it, and particularly Mike and Mike. For their help in pulling this together. This was not a Minyanville issue. It was a Time Warner issue. See, me here now. It's their fault, not ours. They take full responsibility. So, Peter, thank you. I appreciate your time and your help and your content every day. You make me smarter reading you. And thank you to the Minyanville team. I am heading to Iceland. I will report back on the state of the banking system, among other things. And I'll be back in the seat on Monday. So thank you.
Safe travels, my friend.
Thank you.